Okay, everybody, here we are, and as always, we have to talk. So it is a Tuesday, March 3rd, 2020. Here's where we are. Stock trading doesn't start for about 22 minutes. Stock futures are pointing towards a slightly lower open. Okay, in my view, this should be expected after a 1,300 point rally in the Dow Jones Industrial Average yesterday. I mean, that was epic. I expected a bounce, like I said on Sunday, but that one, and we'll see where we're going here. This short-term bounce or whatever this is right now may not be over. And I want to put a perspective on why, and a couple things that we need to see. Number one, literally, is the debt market. The debt market must remain stable. Yesterday, the 10-year yield and the 30 both touched historic lows at one point, and the market didn't like it. Stocks were almost negative. As a matter of fact, the NASDAQ and the S&P 500 did go negative at one point yesterday. And then the debt market stabilized. Stocks just took off at that point. So we need the debt market to stabilize here. We also need crude oil to remain where it is or get bid higher. You know how important crude oil is to this market. It's the lifeblood of the military-industrial complex, which basically runs the world, along with the central banks. So that's what we need to see. We also need to continue to hear what we heard yesterday. The bad news on the coronavirus seems to have, I don't know, maybe slightly dissipated yesterday. That did help the market as well. People are afraid right now of this whole virus thing. The market right now, understand another reason why we saw this monster rally. The market is baking in a series of Federal Reserve rate cuts. The market is baking in, I couldn't even tell you how many tens of billions of dollars in stimulus being pumped into this market. And again, when you have a sitting United States president calling for negative rates, that's going to get the market euphoric. It loves it. It's also going to get the Federal Reserve euphoric. It's incredible. It really is. But again, what's really changed here? We have an economy in meltdown mode. Our manufacturing sector is a dead man walking. Our service sector is dead as well. People are complaining about inflation, but we're being told there's none. The Fed has a 2% target on inflation, and the 30-year yield is nowhere near that. People are getting destroyed, and they're about to get hammered even worse with negative rates that are coming, rate cuts that are coming. Sure, this is potentially, mark my words here, bullish for the stock market. But where does it, you have to understand, cash is not infinitely divisible here. Even if it's printed out of thin air or added to a digital screen, the purchasing power of that cash has got to get sucked from somewhere to boost the stock market. Well, guess where it's coming from? It's coming from you. If you're a member of the middle class, you're being destroyed. You are being destroyed. This is another way to redistribute wealth. Donald Trump is no different than Bernie Sanders. They are both socialists. President Trump wants to bail out the farmers yet again. A massive bailout package is already being talked about. That's socialism when you redistribute wealth. Other companies, other corporations, other sectors of the economy are going to need bailouts. They're going to get it too. It's called socialism. The reason why would you think, let's just say, first of all, as you know, Donald Trump is going to win the next election. But why do so many Americans want Bernie Sanders to win? Because they can't make it. They can't make it in this economy. And they're seeing bailouts for industries. Well, then why shouldn't they get bailed out? Like I said, Donald Trump, Bernie Sanders, they're socialists. I don't care what comes out of Donald Trump's mouth. When you redistribute wealth, You are a socialist. And he is the biggest socialist for the stock market that we have ever seen in the history of the world. He's taking wealth that should be put in the hands of the middle class and sucking it out so the one percenters can gain off of this stock market. And it's going to get much worse. When we correct to fair value, it's going to happen. Whatever members of the middle class out there, even upper middle class people that are in this stock market are going to get fleeced beyond their wildest dreams as the market melts down. Very few people are able to get out of this market like I did. Right before the freaking meltdown that we had last week, I pulled out my cash. As you all know, I'm not putting it to work in this market yet. I am trading it, but I do not have a core position right now. I will re-enter a core position, multiple core positions, when I really get a feel that this market is going back up. I don't believe we're there yet. You still got warnings from some major banks that this is not over. You have some pretty smart Wall Street strategists saying, no, be very careful here. This market is probably going to retest the recent lows. I tend to agree with that, at least now. But again, what do we need to watch? The debt market. If the debt market remains stable and crude oil keeps catching a bid, stocks will more than likely hold their gains or go higher. If the debt market bleeds off, we're in a lot of trouble. If crude bleeds off, we're in a lot of trouble again. But what does that mean for me and my lions? We're going to trade this market. And for you, if you're not a trader, you're still going to bet against this debt and become your own central bank. Big time. Big freaking time. You understand? All right. Pretty much that's it. I think this video has been important here. I covered some important topics, important points here. So let's see where this goes. I'm going to say it again for my lions out here. Remember this. Trade the market you have, okay? Too many people write to me and say, Greg, I did this because I believe this was going to happen tomorrow. Greg, I did this because I believe that. And invariably, they lose money. I hate that. I want to keep all of you, my lions, my lionesses, and my cubs on the right side of this. And for those of you that are not traders, your life is probably easier in a lot of ways here. A lot of guys who follow this blog, they make their living trading the markets. That's what I do. And for those of you that don't, that's fine too. But you still should be understanding you need to be looking at suppressed assets because we know what the central banks are going to do. The market yesterday, that rally, that was stimulus, that was cash being printed out of thin air, being baked into the market. So we'll see. This market has some pretty lofty expectations for the Federal Reserve moving forward. And if those expectations are not met to that degree, the market's going to suffer for a short period of time. But mark my words, we're now in that phase where central banks, especially the Federal Reserve, could not be more happy. They want to issue more debt like you cannot believe. And we haven't seen anything yet. And they're coordinating their effort with the White House, with President Trump, to issue in their final solution to become the lenders and buyers of last resort. That means you are the borrower. And when this all melts down to fair value, and it's going to be absolutely epic, the Federal Reserve will not be blamed. Not only will the Federal Reserve not be blamed, you're going to bail everything out again. It's already in the works, just so you know. The next massive bailout is probably going to be a bail-in, and you are going to supply the funds. Fed's not going to get in trouble. The Wall Street banks are going to walk away scot-free. This is how it was last time. This is what will happen now, although this time the Federal Reserve is in a much, much better spot. They've issued more debt. They are stronger than ever. The Federal Reserve today is the strongest institution on the planet Earth. There's nothing that comes close. Nothing. And understand this too. The enforcement arm of the Federal Reserve is the United States military and all of its might connected with it. All right, I'm out of here. Love you a lot. Please share the video.